I have drawn four major lessons from the recent crisis. One is the lesson that we can never leave a market to do the self-regulating work on its own. We can never leave market to be self-regulating. We have seen the results of self-regulating markets at our great cost. It has become very ineffectual. It has not always resulted even in the most efficient allocation of resources. As you can see, the tilt towards the activities in the financial market. The second lesson that I have learned from this global economic crisis is that while we see predominant activities in the financial markets, at certain period of time, the size of the financial assets on a global basis has been, I would say, more than 3 times the size of global GDP. So with that sizable and dominant role of the financial markets, one did not see. The lesson that I drew was that there was no real positive impact from the predominant role of the financial markets on the real economy, which is supposed to be. When we talked about financial liberalization and financial deepening, we were actually angling for the financial support for the real sectors, for finance to be more efficient, less costly, and to be supportive of trade and economic productive capacity building. But this is not so. There is a detachment between financial market development and real economic development in general. The third lesson that I learned is that while in the past decades we've been trying to adopt the kind of blind faith in the market system, to the detriment of the somewhat ignored government and state role. At the time of the crisis, the state was brought back in a big way, and the state was playing, all the states were playing a pivotal role in trying to rebalance the crisis, to try to reintroduce stability into the crisis, to solve the crisis, and at the same time to be trying to solve the issues of the lack of social development. So the lesson that I have learned, and this is a lesson that UNCTAD has been always trying to establish, that while we are saying that market mechanism could be efficient for certain products, not for all products, we should not forget the role of the states in balancing with the market mechanism, and particularly in trying to help in redistributive policies, to even out the inequalities, to do the social protection, to strengthen participatory politics so that there would be more freedom, and freedom would lead to more competitiveness of the economies and more economic rational. Number 4, the fourth lesson that we have learned is that this is really an interdependent world. It's more interdependent than we would have believed, in that with this crisis originating in the subprime mortgages markets in the United States, it has actually spread throughout the whole world. And now still pockets of the world that are still going through the process of recovering from this crisis. And at the same time, while there is this kind of contagion going on, no one is left untainted. It's to find a way back, to where we used to be with our prosperity. We have to also make use of the interdependent world by having also the global kind of global governance, interdependent, inclusive governance that can help to bring back stability and establish sustainable recovery. Coming out of these four lessons are some of the issues and trends that we have seen that have not always been very helpful in dealing with the issues of growth and equity and inclusive growth and sustainable growth. One is the trend of financialization. This has been an area in which I thought UNCTAD was preeminent in putting our fingers on this financialization issue, and has actually brought to the attention of the global community. In the beginning, it was not really accepted, but now, as one can see how much financializations of the commodities market, asset market around the world, the kind of accumulation of imbalances and debts, one can see why we had to emphasize the issue of financialization. And financialization in itself would have actually not been actually so detrimental without the kind of speculation of financial speculation that has accompanied this financialization process. So financialization has been fed with the financial liberalization policies recommended to us by the Bretton Woods institutions and also by the capital account openness. This has led to the major crisis in Asia in 1997, 1998. And here we are seeing again the issues of financialization not really being dealt with in the way that we would like to see in terms of some financial reform. So here is a trend that I raised in this report, that financialization or finance-led globalization with all the deepening and liberalization actually have not brought the kind of productive capacity build up that we would like to see to generate more employment, but has only created some employment in the financial sectors, but a lot of distortive impacts on the global economy. The second trend that we keep on working and is now becoming something that I hope that it will be part of the way we are looking at the new perspective of development-led globalization, is the how to avoid the debt-driven growth. Growth has been driven by debt, because in all this crises that we have seen, they're all mainly driven by excessive debts accumulation, either in the private sector or in the public sectors. It has always been more or less related to the so-called the balance sheet crisis with banks, with households, with governments. So how can we deal with the kind of financial imbalances that are still around in this world? Imbalances contracted in the midst of the crisis in 2008, 2009, but after the recovery, even though recovery is not yet full-fledged, the imbalances beginning to expand again. We have seen declining saving rates. We have seen exchange rate movements, misalignments, movements that are not actually rational, based on the country's competitiveness and trading positions. We have seen the average debt to GDP rates for advanced countries going up from acceptable level of 50% in 1995 to over 300% now. So this is another issue that will be included in the way we look at the future. And what we are now trying to do is to look at the theme of sustainable debts and responsible lending and borrowing practices that we have discussed since the 1990s, when we said that both the borrowing countries and the lending countries are equally responsible for the crisis, and not only the push to have the adjustment to be committed to only by the deficit countries, by the borrowing countries, has always been a bit partial. It's not complete. It's not the correct way to approach. We always believe that to deal with the debt-driven growth issues, we need to deal with both sides of the sustainable debt issues, both lenders and borrowers. The third trend that, of course, we now have to cope with is that we're seeing small economic business cycles, shocks, crises, recurring with frequencies that we have not seen before. There has been more swings, rapid swings in asset prices, property values, exchange rates, that has led to various economic shocks and crises around the world. So these are things we have to deal with in the light with the lessons we have learned, and these are some of the consequences. I would like to conclude by saying that, I mean, the report deals with many detailed issues in trade, investment, commodities, and other things. But let me conclude by going towards the end of the report, when I try to come up with some what we call the new development consensus. Here, what we are trying to state is that, yes, first of all, the pivotal role of developmental state must be established. The central role of the state must be established. But of course, here we need more engagement of policymakers, academics, around the world to establish the real content of and roles of developmental state. By saying developmental state, we try to send out the signals that we don't want the states to be re-entering the marketplace as another operator. We want the states to be helpful to the markets, to help in giving markets directions that can be helpful to solve some of the economic and social issues. That the state could be hands and support where market cannot actually mobilize the support. For example, in the new areas of sustainable development, in renewable energies, in green economy, in investment in clean in clean equipment, and in the reduction of the emissions of carbon dioxide. So here we see the pivotal role of the state, and we call it developmental state, and this is a role that must be well thought out and well defined in a way that we're not going back to the bad old days of the states becoming a major player. Although what we've seen during the crisis was that the state had to come back in and become a pivotal player in rescuing some of the financial institutions. But the state must be able to map out balanced growth that must be maintained with a larger and increasing degree of equality. Now what we have seen in the past, and every time I have been discussing the issues of inequality, my pronouncement and conclusion every time, and I look back in a few decades of discussion I had on growth and inequality, is that if I look at the set of policies available at the time that I was discussing, I didn't expect equality to be increased, to be enhanced. In fact, inequalities has been gaining ground. And again, at the moment, if I look at the situation at the moment, how much we are still reliant on the financial markets, I would say that the developmental role of the state must be very much explicit in the way that we deal with inequality. There must be redistributive policies explicitly adopted by developmental states so that we can actually temper the rise in inequality.